Welcome to XRP Pro Ledger, and what I'm about to lay out for you in the next several minutes is the kind of institutional intelligence that does not show up in your newsfeed, does not get covered by mainstream financial media, and does not get discussed openly by the analysts who depend on Wall Street relationships to keep their seats at the table. $35 trillion of institutional capital is moving right now. Not preparing to move, not considering moving, actively moving as BlackRock, Morgan Stanley, Charles Schwab, and Franklin Templeton execute the largest coordinated institutional pivot toward digital assets in the history of financial markets. And at the exact same moment, former CIA financial warfare advisor Jim Rickards has gone on record with a warning that the $300 billion stablecoin market is facing an inevitable collapse, not a possibility, not a risk scenario, a certainty. And the only assets that will survive that collapse are the ones that are structurally built outside the collateral chain that is going to break. Stick around until the end of this video, because I am going to reveal the exact year that Ripple's quantum-resistant upgrade will make every other blockchain architecture institutionally obsolete, and the timeline is going to shock you. Let us get into it. The $35 trillion institutional tsunami is not a metaphor, and it is not a projection. It is a description of capital flows that are actively underway right now from four of the most powerful and widely distributed financial institutions in the world. Start with Morgan Stanley. They are not filing an ETF and waiting for advisors to figure it out on their own. They are actively deploying 16,000 financial advisors to sell crypto products to their client base. That is not a passive distribution strategy. That is a fully mobilized sales force with product knowledge, client targeting, and incentive structures aligned around getting crypto allocations into Morgan Stanley managed portfolios at scale. 16,000 advisors, each with an average book of business in the hundreds of millions, representing a combined distribution channel for crypto assets that makes every previous institutional adoption announcement look like a test run. Charles Schwab, Franklin Templeton, and BlackRock are moving in parallel, each building the custody infrastructure, the product wrappers, and the regulatory frameworks that allow their client bases to access digital assets through familiar, compliant financial instruments. This is not retail adoption. This is the financial system deciding that digital assets are a permanent feature of institutional portfolios and executing on that decision with the full weight of their distribution infrastructure. Jim Rickards is not a crypto commentator. He is not a blockchain evangelist. He is a former advisor to the CIA on financial warfare, a man whose entire professional career has been built around understanding how financial systems fail, how they are weaponized, and how the people and institutions that see the failure coming protect themselves before it arrives. When someone with that background and that credibility goes on record saying that the $300 billion stablecoin market faces an inevitable collapse, that it is a matter of when, not if, the serious financial analysts in the room do not dismiss it as FUD, they start asking what assets are structurally positioned to survive the collapse he is describing. Rickards' specific concern is the Treasury bill hoarding and unaudited reserves that underpin the majority of stablecoin collateralization, the same structural vulnerabilities that have been documented in regulatory filings and academic research, but largely ignored by the retail market because the yields were good and the pegs were holding. When the peg breaks at scale, the collateral chain that connects stablecoins to treasury bills to money market funds to repo markets will transmit the shock across the entire traditional finance system simultaneously. The assets that survive are the ones outside that collateral chain. XRP is structurally outside the collateral chain that Rickards is describing, and understanding why that structural positioning matters requires a brief explanation of how the stablecoin collapse mechanism would actually propagate through the financial system. Major stablecoins maintain their dollar pegs by holding treasury bills and short-term government securities as reserves. The stablecoin is essentially a tokenized claim on those reserves. When confidence in the peg breaks, holders rush to redeem stablecoins for dollars, which requires the stablecoin issuer to liquidate treasury bill positions to fund redemptions. Large-scale treasury bill liquidation by stablecoin issuers simultaneously puts downward pressure on treasury prices, raises yields, tightens credit conditions, and triggers margin calls across the leveraged positions in traditional finance that are exposed to rising rates. XRP is not a claim on treasury bills. It is not backed by reserves that can be liquidated. It is a native digital asset whose value is derived from its utility as a settlement layer, and settlement utility does not disappear during a financial crisis. It increases because the institutions whose existing settlement infrastructure is failing need an alternative, and the alternative that has been quietly building institutional relationships for a decade is XRP. The security architecture of the XRP ledger is the feature that the institutional allocation decisions being made by BlackRock, Morgan Stanley, and Goldman Sachs are built on, and it deserves to be understood in its full technical context rather than summarized with the generic phrase that XRP is more secure than other blockchains. Here is the specific and verifiable fact: the XRP ledger has operated for 13 years without a single protocol-level exploit. 13 years of continuous operation, processing billions of transactions, securing hundreds of billions of dollars in value, with zero successful attacks on the core protocol. Compare that to the DeFi landscape on other networks, where multi-hundred-million-dollar bridge exploits happen with such regularity that the industry has essentially normalized them as a cost of doing business. The Kelp.io hack at $292 million, the Ronin bridge at $625 million, the wormhole exploit at $320 million. These are not anomalies in the broader DeFi space. They are the predictable consequence of building complex, layered smart contract systems that expose enormous attack surfaces to a global population of highly sophisticated adversaries. XRPL's design philosophy, building financial functionality directly into the protocol layer rather than on top of it through arbitrary smart contracts, is not a limitation. It is the reason the ledger has never been successfully exploited. Ripple's CTO David Schwartz's recent public warning about DeFi bridge vulnerabilities, which we covered in detail in a previous video, is the technical leadership of the most institutionally trusted blockchain in the world, publicly reinforcing the security standards that make XRPL the only viable infrastructure for institutional scale capital deployment. When the institutions evaluating where to build their digital asset settlement infrastructure see a CTO proactively flagging security risks rather than downplaying them, they are seeing exactly the kind of risk management culture that their own compliance frameworks require them to find before they commit institutional capital. The XRPL is the adult in the room in the DeFi space. It is the infrastructure that was built to handle real money at institutional scale from day one, while the rest of the space was optimizing for yield, composability, and retail engagement. That design priority is now the most valuable feature any blockchain can have, because the institutions with the largest capital pools are moving, and they are moving specifically because they need infrastructure that will not get hacked. Now let us talk about the quantum computing threat, because this is the development that most retail crypto investors are treating as a distant future concern, while the institutions with the longest time horizons and the most sophisticated technology research divisions are treating it as an 18 to 24-month operational risk. Quantum computers derive their power from the ability to perform certain mathematical operations exponentially faster than classical computers, specifically the operations that underpin the public key cryptography that secures every blockchain network currently in operation. The elliptic curve cryptography that protects Bitcoin wallets, Ethereum transactions, and the vast majority of digital asset private keys is theoretically vulnerable to a sufficiently powerful quantum computer running Shor's algorithm. The debate in the academic and institutional research community is not whether quantum computers will eventually be able to break current blockchain cryptography. The physics is settled on that question. The debate is about timeline, and the institutions that are making 10 to 20-year infrastructure commitments today are the institutions that are taking the shorter timeline estimates seriously. Ripple's active development of post-quantum cryptographic upgrades for the XRP ledger, targeting a 2028 implementation timeline, is not a defensive response to a theoretical concern. It is a proactive infrastructure decision made by a technical team that has access to the same institutional research on quantum computing timelines that the largest banks and government agencies are using to make their own infrastructure decisions. The 2028 target is significant because it positions XRPL to achieve quantum resistance before the most aggressive credible timelines for quantum computing capability would begin to threaten current cryptographic standards. An institution that is evaluating blockchain infrastructure for a 10-year deployment is not asking whether the infrastructure is secure today. They are asking whether it will be secure in 2030, 2032, and 2035. Ripple is the only major blockchain infrastructure company that is publicly committed to a specific timeline for post-quantum cryptographic implementation, and that commitment is a competitive differentiation that the institutions building 10-year infrastructure plans are absolutely factoring into their evaluation process. The geopolitical dimension of digital asset positioning requires honesty about subjects that most crypto content creators avoid because they are controversial and complicated, but understanding these dynamics is essential for anyone who wants to understand why the current institutional allocation toward XRP specifically, rather than other digital assets, is happening in the pattern and at the scale that it is. Bitcoin's cryptographic foundations have documented connections to earlier NSA cryptography research, and its blockchain architecture provides complete transaction transparency that functions as a perfect ledger for financial surveillance. This does not make Bitcoin valueless. In fact, it makes Bitcoin extraordinarily valuable for specific use cases, particularly as a decentralized store of value and as a test ground for proving that blockchain-based digital assets can achieve mainstream adoption without centralized control. Bitcoin and XRP are not competing for the same institutional role. Bitcoin is the decentralized, transparent, globally accessible store of value. XRP is the settlement layer, the infrastructure through which central banks, commercial banks, and institutional asset managers move regulated value across borders at institutional speed and scale. These are complementary functions, not competing ones. An understanding that complementarity is essential for understanding why Goldman Sachs can simultaneously hold Bitcoin ETFs and XRP ETFs without contradiction. The CBDC integration dimension of XRP's institutional positioning is the piece of the story that ties geopolitics, regulatory frameworks, and financial infrastructure together into a single coherent thesis. Central bank digital currencies, the digital versions of sovereign currencies being developed by central banks around the world, including the Federal Reserve, the European Central Bank, and the People's Bank of China, need an interoperability layer. A digital dollar needs to be able to settle against a digital euro, a digital yuan, and a digital yen in real time across different regulatory jurisdictions with instant finality and without counterparty risk. The XRP Ledger's architecture, specifically its ability to serve as a neutral bridge currency between different digital assets, its 3 to 5 second settlement finality, its decade-plus track record of zero protocol-level exploits, and its active development of post-quantum cryptographic resistance positions it as the most technically and institutionally viable candidate for that CBDC interoperability role. The institutions that are deploying $35 trillion toward digital asset infrastructure right now are not doing so in isolation from the CBDC development that is happening simultaneously at the sovereign level. They are building the private sector infrastructure that will interface with the public sector CBDC systems when those systems go live, and the interface layer they are building runs on XRP. The price picture at the current $1.42 to $1.43 consolidation level, when viewed through the lens of everything we have covered in this video, is not a story about technical resistance or market indecision. It is a story about institutional accumulation happening beneath a price level that has not yet reflected the full weight of the fundamental developments pressing against it. $35 trillion of institutional capital mobilizing, a CIA financial warfare advisor warning that the stablecoin market faces inevitable collapse, the only blockchain with a 13-year zero exploit track record, a post-quantum cryptographic upgrade targeting 2028, a CBDC interoperability positioning across multiple sovereign digital currency programs, Goldman Sachs across 4 funds, the Clarity Act hitting the Senate Banking Committee this week. Each of these developments independently would be a meaningful catalyst for XRP price discovery. Together, they represent a convergence that the current price level cannot contain indefinitely. The institutions are not buying because they expect XRP to go up. They are buying because the infrastructure they need to exist already exists. It has been proven over 13 years, and the window to accumulate before the rest of the market understands the full picture is closing faster than most retail investors realize. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.